China's push for more control in the gold market was seen with the launch of its yuan-denominated gold price fix on Tuesday. But how much impact will the Shanghai Gold Benchmark Price have on the market, and what is it going up against? To help us make sense of the move is the World Gold Council's Collett. Greg joins us now in studio. Greg, thanks so much for being with us.
Thanks for having me, Daniela.
So we saw this big news come out yesterday on Tuesday. You know, what is it going up against? You know, the gold fix, the new yuan-denominated gold fix is going up against New York and London. Does it really have a place in the market? What are your thoughts?
Sure. We view this as a stepping stone to a multi-axis trading market that will consist of London, New York, and Shanghai. China is the largest consumer of gold in the world, and so this is just reflective of their growing place and the growing demand for gold in China.
So what do you think are the implications, if any, behind the benchmark? Is China trying to attract more gold investment products to the country?
I think a few things. One, I think anytime you have further transparency and further insight into the market, you're going to see more investment products spring out of that. Also, one of the implications is all commodities, gold included, have location-based price differences. And so this will just allow investors to get a little bit of a better sense of what is the difference in price in China versus these other markets.
Well, I think a lot of people were wondering, about the timing of the move. Why now? Do you think that has any relevance?
I think the timing is largely driven just by the increased demand coming from consumers in China, and just, again, China's just growing presence in the market.
What about this other news that we're hearing of China and Russia looking to create a platform together to facilitate trading?
Yeah, that I'm not sure is currently a factor in the markets. I think China's effort with the Shanghai Gold Exchange on its own is really the primary driver of this news right now.
All right, let's switch gears and talk about gold investment interest, which really is your expertise here. And you mentioned that gold ETFs are seeing the longest winning streak since 2009. They've brought in 13.4 billion in 11 weeks straight. What does this say about the appetite for gold right now?
Well, I think this is fascinating. I think what's going on in the gold market, so year to date, gold is up about 20%. Like you said, ETFs have brought in a huge amount. GLD, which is the ETF that we sponsor, we saw it go from about 22 billion to about 32 billion in assets under management. And this is a huge increase over a relatively short space of time. Right. I think what we're seeing is investors looking around the world and seeing that we have low to negative interest rates with so many bonds out there. And when they see that, they say, well, what role are those bonds playing in my portfolio? And they come to the conclusion that gold would probably be a better diversifier than having quite such a large bond portion to my portfolio.
And do you think that this appetite will continue for the rest of the year? What's your forecast?
I do. I mean, because we think that these negative interest rates are one of the primary drivers of this gold demand, we don't see that changing anytime soon. So I think it stands to reason that that should carry on.
Greg, thanks so much for your thoughts.
You're welcome.
Thanks
for having me.
And thanks for watching this edition of Kitco's Gold Report. We'll see you tomorrow.